Good afternoon. Hello, this is BMP Wealth in Hong Kong. My name is Howard Clark Burton. My co-presenter today will be Jason Pierce from Quilters. A little bit about BMP first. We are a Hong Kong-based international wealth management company. Most of the advisors here worked in the UK and also in Hong Kong, so we've got good insight on both areas. And what we really do with clients is we look at ways to make sure people have enough money for the rest of their lives. And generally, as people are too little, just the right amount, or too much, believe it or not, especially when you consider taxes. So we work with clients in all the realms of that. Today, we're talking about moving to the UK. So one aspect of what we do regularly with the British expats that we work with, and a number of overseas educated Chinese as well. When they move to the UK, what are the things that we need to be looking out for? Jason will kick off with some of the theory, and I'll give some examples at the end. So please do wait to the end. The whole show will take about an hour. And please ask questions as we go along. At the bottom of your screens, you've got the chat button. Feel free to type up a question as we go along, and we'll try and answer it as we go along. If not, then we'll save it to the end as well. We'll circulate this presentation afterwards, a video recording of it, so feel free to just pay attention. You don't need to take notes for now. Now, in terms of technology, we're sat in the same room here with Jason, so I'm just going to hand over to Jason by switching seats. Over to you, Jason.
Thanks, Howard, and good afternoon, everybody. Thank you for joining us. So I'm going to give you a brief introduction to UK taxes, because if you've never lived in the UK, it's very different to Hong Kong. And even if you're a British expat that originally lived in the UK, but you've been out a few years, there's regular changes to UK tax. There's been a lot in the last 10 or 15 years. So for British expats repatriating, you'll find that the tax system that you move back to is very different to the one that you moved away from some years ago. So just by way of introduction, when you see something that's in green font and it's bold and underlined, it means that it's a particular legal or a technical term, and it might have a meaning that's slightly different to its normal English usage. I'll show you an example very shortly. So for the purposes of exchange, I'm just going to simply use 10 Hong Kong dollars to 1 sterling, and then some acronyms. HMRC, that's the UK's version of the IRD. They're the people that collect taxes. Capital gains tax, which we don't obviously have in Hong Kong, but we very much do in the UK, and inheritance tax, same thing. So that's charged when somebody passes away. So first thing to note then is, what is UK residence? Because if you are a UK resident, you're in the UK tax system, and by that I mean tax resident. So in Hong Kong, it's very simple. If you spend 150 days of the year in Hong Kong, or 300 days over a period of 2 years, then you are tax resident in Hong Kong. In the UK, the first thing to say is that the tax year is slightly different. It begins on the 6th of April, runs through to the following 5th of April for historical reasons. And there is a simple day count. So whether you're resident or not in the UK will depend upon the number of days that you spend in the UK, and each tax year is completely separate. So it's possible to be tax resident 1 year, not resident the following year, resident again the year after that. But you'll see their days as in green and bold underlined, because it has a particular technical meaning. It actually means being there at midnight. So if you're flying into the UK and your plane lands at 5 to midnight, that is a day of residence in the UK for that day that ends at midnight. If your plane lands at 5 past midnight, then you're not resident for the day before the midnight, but you obviously will be for the day following your arrival. Now, if you're there for 15 or fewer days, or 15 or fewer midnights, then you are categorically not UK tax residents. So anyone can spend up to 15 days in the UK and not be tax resident there. And remember, our starting point is 6th of April to 5th of April, not the calendar year. Okay, at the other end of the scale, if you're there for more than 183 days, or approximately 6 months, then you are categorically resident. So anyone that spends 183 or more days in the UK between April and April is categorically tax resident for the whole tax year. But what if you're in between? Well, if you are, you'll need to take something called the statutory residence test. And if you're coming in and out of the UK, you may well need to take this every year to see whether you're tax resident for that particular year. So this is a statutory residence test flowchart. All the accountants produce these. This is the one that my company produces. It takes about 2 minutes just to work your way through it, to answer the questions, and that will tell you at the bottom whether or not you're UK tax resident, depending upon the number of days that you're there. So if you're going to the UK, then we're looking at the right-hand side. And if you haven't been tax resident for any of the previous 3 tax years, then you can actually spend up to 45 days in the UK in the tax year, but not be tax resident. Other end of the scale, like we said, if it's 183 or more, you're always resident. But if you're in between 45 and 183, it will then depend upon the number of what we call ties you have to the UK. Those are things like, do you have a home in the UK, or is your family there with you? Have you got a job there? And then it can be one of 3 different thresholds. So in Hong Kong, it's very simple. They only have 2. The UK, it's more complicated. We have to have 5. So, but the flowchart will tell you how many days you can spend in the UK in between April and April before becoming tax resident. So, but if you are there, if you've got a lot of ties to the UK, so you've got a home there, your family and go with you and so on, it could be only 46 days of the tax year, but you're tax resident for the whole of the year. That means that you could be a UK tax resident before you actually go there. You can be living in Hong Kong, but you have plans to go to the UK partway through the tax year. Your tax residency, so you could move to the UK in, say, September, but you could go there and find that your tax residency actually began the previous April. So that clearly has tax consequences. And for that reason, it's always advisable, if possible, to arrange your finances in the tax year before the one in which you move to the UK. So always start planning as soon as possible. Otherwise, you could end up with a nasty surprise tax-wise. So that's UK residence. But in the UK, we have another concept that affects your tax, which is called domicile. Now, residency it's not simple, but it's straightforward. It's a simple day count. But we have this other concept called domicile, or DOM for short. Now, this is an entirely different legal construct to residence. Okay, most countries don't have domicile. Hong Kong certainly doesn't. They just use residence to determine your tax affairs. But it's also different to your citizenship, your passport, your nationality. These are all completely different things in English law. So it's very broadly, because there is no single legal definition, it's broadly the country that you have as your permanent home, or the one with which you have the most substantial connections. So for Hong Kong people moving to the UK, initially they will still have a Hong Kong domicile because they've been born in Hong Kong, brought up here, and still have probably family here and connections here as well. Now, everyone begins life with a domicile of origin. If your parents were married on the day you were born, then you get the domicile of your father. But if your parents were not married, you take the domicile of your mother. And here's an example of this. This is a real person, as a good friend of mine. So he was born in London. His father was Russian, his mother's English. They were in a long-term relationship, but they weren't legally married. So he grew up in the UK, moved to Hong Kong to work. He lived here for 9 years, got permanent residency, and then his job took him afterwards to Australia, which is where he is currently. So Dimitri then, he has Russian nationality from his father. So he's got a Russian passport, Russian nationality. But because his parents weren't married, he takes his mother's domicile. So he has UK domicile. Okay, he also has Hong Kong permanent residency because he spent more than 7 years here. And now he's actually resident in Australia. So Dimitri has connections which affect his tax with 4 different countries all at the same time. So this is just to illustrate how domicile is different to nationality and residence. Okay, now for UK tax purposes, everyone has a domicile. Now, if you've never had any connection with the UK and never will have, then it's obviously irrelevant. But if you're watching this presentation, I'm guessing it's because you are thinking of moving to the UK, in which case domicile is very much relevant to you. So if you've ever lived there, or you intend to live there, or if you were born there, your parents were born there, or if you own property in the UK, then your domicile is crucial. Now, you can only have one domicile at a time, so you can't be domiciled both in Hong Kong and in the UK, but it can be changed. So it is possible to move to the UK with a Hong Kong domicile, and in a couple of circumstances that I'll cover, your domicile can change from Hong Kong to the UK, and that will affect how you're taxed. Okay, so if you're UK resident but not domiciled in the UK, or what we call a non-dom, there are some potential tax advantages which are good. So we'll cover more of those later as well. In terms of the UK taxes that you need to be aware of, well, first of all, the Hong Kong taxes and UK taxes are very different. For a start, the Hong Kong tax code is comparatively short. It's only 276 pages. In Australia, for comparison, it's 6,000 pages. But the last time anyone counted in the UK was 2015, when it was 17,000 pages long. Now, we've had 3 or 4 budgets since then, so it's probably now more like 20,000 pages long. Okay, 10 million words. It's about 12 times as long as the Bible, if you're familiar with that book. Okay, that's what it looks like. Okay, so as well as the complexity and the length, there's also a fundamental difference as well. So there's basically 4 different ways that personal taxation can be organized. So around the world, the first one is the simplest and probably the best, which is where there's no income tax at all. So that's the countries in green, most famously Dubai, where there is no personal income tax. Then you have what's called territorial taxation in the light blue, which is what we have here in Hong Kong and in Singapore and Malaysia. And that's where you're only subject to tax on Hong Kong source income. If you have any overseas income from a bank account in Jersey and so on, that is not subject to Hong Kong tax. But this is very unusual. If you look at the map of the world, there aren't many countries in light blue. Most of the world is dark blue, which is residence-based taxation. And that's where if you're resident in the country, you're subject to tax and capital gains tax on your worldwide income and gains. Okay, so that's the UK, Australia, most of the rest of the world. And then you have, lastly, the most comprehensive, which is based upon your citizenship, most famously the USA, where if you are a US person, it doesn't matter where you're living in the world, you are still subject to US tax, and probably also tax in the country in which you're living. So you could end up paying an awful lot of tax as an expat American. Okay, so just by way of background to illustrate why UK taxes are so much higher than Hong Kong taxes, which you'll see, what I've got here is from the Census Department from the Hong Kong government. Basically their accounts of how much money the government spends. So in 2019 to 2020, it was 609 billion Hong Kong dollars. Okay, so that's the total government expenditure for that financial year. So in Australia, for comparison purposes there, it's about, well, they do it quarterly. I'll show you the total figures in a second. And then in the UK, these are the public spending statistics from this time last year, and the total government expenditure, or the managed expenditures, you can see is 843 billion sterling. So that's a load of numbers here. What I'm going to just do is put them all into a table and convert the currencies. So here's the government expenditure for each of the 3 governments in local currency. But obviously, the UK, Australia, and Hong Kong have different populations. So there's the populations there. So what I'm going to do to make it equal is to say, what is the expenditure per person living there, or the expenditure per capita in the local currency to begin with. So those are the figures there. So Hong Kong spends 81,000 Hong Kong dollars for every person living in Hong Kong. The UK government spends £12,000. Let's now convert it all into Hong Kong dollars so that you got a feel of how much more is spent there. So Hong Kong, 81,000, the Australian government almost twice that amount, and the UK 50% more. So the UK government spends 50% more money per person than the Hong Kong government does. That's because we have things like free schools, free hospitals, old age pensions, social security, and so on. So the main reason why UK taxes are so much higher than they are in Hong Kong is that the government in the UK spends a lot more money per person than the Hong Kong government does. And that has to be paid for. Okay, so when are UK taxes payable? So I've broken these down into different types of taxes. So the first line is then, this is somebody who's not a UK resident, not UK domicile, so a Hong Kong person living in Hong Kong. But if you have any UK sourced income, so if you've got a bank account there paying interest, or investment property, because it's in the UK, it is subject to tax. So while you're still living in Hong Kong and not a UK domicile, UK-based income is taxed in the UK, but clearly non-UK income is not. But if you've got investment property in the UK, you've got a buy-to-let or a family home you're renting out there, the rental income is subject to capital gains tax, income tax. If you sell the property at a profit, that is now subject to capital gains tax. It never used to be, but there was a tax change in 2015, which brought gains on property into the tax system, even for people that are not living in the UK. So if you sold your property before the 5th of April 2015, you wouldn't have paid any tax on the gain. Since then, you will do. Okay. Inheritance tax, again, prior to the year 2017, you could structure the holding of a property so it wasn't subject to UK inheritance tax. But since 2017, it's impossible now to get around it. That will be subject to inheritance tax if you pass away. If you own any other assets in the UK, so if you've got a family home there and the home contains antiques or paintings or anything like that, because they're physically situated in the UK, they are subject to inheritance tax when the owner passes away. Any assets that are not in the UK, though, aren't going to be subject to UK inheritance tax because of the domicile of the owner. So that's somebody that's not yet moved to the UK. So they're still potentially liable to UK taxes, especially on property, even though they aren't living there. But then let's say you move to the UK, but you retain your Hong Kong domicile. So again, UK-based income is always going to be taxed, but your non-UK income, even though we have residence-based taxation, is actually not liable to UK income tax if you use the remittance basis, and I'll explain about that in just a second now. UK investment property, always taxed, doesn't matter where you're living, where you're domiciled. Inheritance tax, same thing. If it's in the UK, it's taxable, but if you're still a non-domicile, then you don't pay UK inheritance tax on, for instance, your property in Hong Kong. When you move to the UK, if your domicile changes from Hong Kong to the UK, and there's a couple of ways that can happen, then you are basically then taxed in exactly the same way as someone born and raised in the UK would be. So you pay tax on your worldwide income and gains and your worldwide assets when you pass away. Okay, so let's talk a little bit more about the remittance basis then, which is this tax advantage for non-DOMs who are going to move to the UK. So there's basically two different methods available to you, and you can choose each tax year which of the two you want to use, which is the best one for you. The first one is what's called the arising basis, and this is when income and gains are taxed as they arise. So you'll obviously pay UK income tax and capital gains tax on your worldwide income as they arise. So tax the same as the way a British person would be. But the alternative for a non-DOM is the remittance basis. So UK income and gains taxed anyway, there's no way around that. If you have any non-UK income and gains that you bring into the UK, the technical term is remit, then that will enter the UK tax system and be subject to tax. Probably the most common example is you move to the UK, you still own property in Hong Kong that produces rental income. If you transmit that rental income or transfer it or remit it to the UK, that will be taxed in the UK because it's entered the UK tax system. Or if you own a property in Hong Kong that you sell with a profit, and it's a buy-to-let property, if you remit the sales proceeds from selling that property to the UK, that will be taxed in the UK. But if you don't remit it to the UK, if you leave it in Hong Kong, then you don't have to pay UK tax on it. Okay, so it stays outside the UK tax net. So this is an advantage that a non-DOM has, because for a British person living in the UK, they cannot access the remittance basis. They have to pay the arising basis. Okay, so each tax year, 6th of April to 5th of April, you decide which one is the best for you. And you can do this for up to 15 years. After that, you can't do it. But for 15 years, at least, you have this potential tax advantage. Now, you wait until the end of the tax year, which is the 5th of April. You've then got a few months that you need to decide which of the two methods you're going to use to pay tax by the 31st of January following that. So once the tax year is ended, you've got a clear picture of all your financial transactions. You can choose which of the two bases is best for you. Now, for the first 7 years, there's no charge to use the remittance basis. So everybody who goes to the UK always uses the remittance basis instead of the arising basis for the first 7 years. But from year 8 onwards and up until year 12, if you want to continue using the remittance basis, then you have to pay for it. So you pay the remittance basis charge, which starts at 30,000 sterling a year. And then you also have to pay tax on top of that for any income and gains that you remit into the UK. From years 13 to 15, the charge goes up to £60,000 a year. So if you're in that position, then you need to work out how much your offshore, your non-UK income and gains are. If they're less than £60,000, then you may as well pay tax on the arising basis. But, so you've got plenty of time each year to make the decision whether you want to use the arising basis or the remittance basis. From the year 16 onwards, you'll be what's called deemed UK domicile, and that's where you'll be taxed in exactly the same way as a native British person. You've basically been in the UK for long enough to be taxed in the same way. So from year 16 onwards, you don't have the option of the remittance basis. You'll pay full UK taxes. So how can you, or how is it possible for your Hong Kong domicile to change to a UK domicile? Well, there's three different ways in which it could happen. If it does happen, or when it happens in some cases, it brings your worldwide assets into the UK tax net for all UK taxes. So the first one is a simple year count. So it's the 15 out of 20 years UK residence. So for the first 15, you're not taxed on your worldwide income and gains, but from the start of year 16 onwards, you are. It used to be 17 out of 20 years, and they reduced the amount in 2017. So more people now are caught earlier with the deemed domicile rule. They could change it again. They could reduce it to 12 years or 10 years and so on, but currently it's 15 out of 20 years. The second one, though, is not quite so clear. This is what's called acquiring a domicile of choice in the UK. Now, again, there's no strict legal definition of this, but generally it's where you have an intention to settle either permanently or indefinitely in the UK. Now, clearly, if your domicile does change to the UK, you're going to end up paying a lot more tax. So some people who move to the UK have the intention to settle there, but they don't really want to be regarded as doing that because they're going to pay a lot more tax. So the HMRC, the tax collectors in the UK could say, right, you've been here, it's obvious you've settled permanently, you bought property, you've set up a business, your family have settled here. You could say, well, actually, no, I plan to leave the UK in a few years' time. If it ends up in a dispute, and it frequently does, this can only be settled in court because there is no strict legislation on this. And the UK courts are very busy with determining people's domicile where there's a dispute between the taxpayer and the tax collector. The third way is a domicile of election. We haven't got time to cover that today, so I'm going to move on to basically this. If you think your domicile is going to change because either it's a simple year count, the 15 out of 20 years, or you think your intention is to settle in the UK, with advanced financial planning, you can protect a lot of your assets from UK taxes. The key is always to take good advice from an advisor that understands UK taxes and to do some financial planning. So in terms of the different taxes then and the order that they're applied, well, the first one is on all earnings and pensions. So anything that arises in the UK or is remitted to the UK. So if you've got a job there, if you're in receipt of a pension there, that is subject to UK income tax. Now, that's different to Hong Kong. In Hong Kong, pension and annuity income generally is not taxable, but in the UK, it absolutely is because it's a form of income. And the UK has rental income, which is similar to Hong Kong property tax. Now, if you're living in Hong Kong, that's the only sort of taxes that you need to be concerned with. If you're in the UK, it's very different. There are a few levels on top of this that you also need to be aware of. The next level then is savings income. So this is typically bank account interest. That's fully taxable in the UK, unlike in Hong Kong, and any other form of savings interest that you receive as well from bonds and so on. Then on top of that, you've got dividend income. That's also fully taxable in the UK. It doesn't matter whether it's a listed public company, like you own shares in Tesla that pay a dividend, or if it's your own private company and you're taking dividends from that. And even if you own an equity income fund that pays income, that's also going to be taxed as well. Then on top of that, you've got insurance policy gains. Now, these are subject to a particular form of income tax known as the chargeable event rules. There is potential tax to pay, but it is actually very advantageous, and I'll cover more how we'll cover that later. And then on top of all of that, you've then got capital gains as well. So capital gains aren't, strictly speaking, income, but the rate that you pay depends upon the total level of your income and gains. And I'll show you the levels in just a second. So in very, very simple terms, because there are various allowances and reliefs, what I'm going to show you is, in very simple terms, what the amount of tax or the tax rates are. So on the first £50,000 sterling, the next 50 to 150, and then everything above 150. So this is simplified, but it will give you a good feel. So your income tax rate, 20, 40 or 45%. So that's the top rate of income tax in the UK. Then you've got capital gains tax, and there are special rates for residential property. Doesn't matter whether it's in the UK or in Hong Kong. If it's residential property, it's subject to these rates. So when you sell it, any gain that you've made will be taxed either at 18 or 28%, depending upon your total of your income gains. Other assets, so things like stocks and shares, mutual funds, anything like that you sell, the rates are lower, 10 and 20%. Now, those are the rates as they are today, okay, the 23rd of February, but we have a UK budget on the 3rd of March, next Wednesday, a week today. This was something that was reported last summer in the UK in August. The government is planning to raise both capital gains tax and corporation tax. Now, you don't need to worry about corporation tax, but it's likely that the rates of capital gains tax that I've just shown you could be raised. We just need to wait and see. By this time next week in a day, we're going to know. Now, because there's different rates, what I've actually done then is calculated the real numbers, because whatever your income is, you'll pay some income tax at 20, some at 40, maybe some at 45. So if your income is any one of these 6 figures here, the actual income tax you'll pay is then shown there. So if your total UK income and remitted income is 150,000 sterling, you will pay £52,500 in income tax in the UK. So in terms of the actual effective rate, then you can see there, that's an effective rate of 35%. But if your income is, say, £500,000 a year, your effective rate is 42%, and then it goes up. Now, because you'll always be paying some at 20 and some at 40%, you'll never quite reach 45% effective rate, but you will get close to it. Okay, so very high taxes then. So the remittance basis is a good thing if you can afford to keep your Hong Kong income gains out of the UK and therefore not subject to UK tax. That's clearly some good financial planning. But it is possible to actually make a remittance into the UK without perhaps realizing it. And there are lots of traps that people in the UK that use the remittance basis fall into on a regular basis. When I worked in the UK, I come across people all the time that had made a remittance without being aware of it. Now, it doesn't just apply to you as the individual taxpayer, it applies to people and entities that you're connected with. And I'll show you that in just a second. And there are traps that you can fall into. Now, it's crucial that your banker in Hong Kong or your bankers understand and how this is going to work for you. And they need to be given clear instructions about how they manage your accounts once you become UK tax residents. Okay, but there are planning solutions which Howard's going to cover, which will solve all of these problems. So a remittance into the UK then, well, most obviously any cash that's transferred into the UK is clearly a remittance. So you transfer some money from your Hong Kong bank account to your UK bank account, very obviously that's a remittance, but it isn't just that, okay? If you are not in the UK, so you're back in Hong Kong or you're on holiday in Europe or in Asia, and you buy any item with your Hong Kong income and gains, and then you physically bring the item into the UK, that is a remittance. And the amount of the remittance is whatever it cost you to buy that asset. So I've used a painting as an example. So you're in Thailand on holiday, you buy a painting there with your Hong Kong income, you take the painting into the UK to hang up in your UK house. That is a remittance. The amount of money you spent on that painting is taxable in the UK, even though it's not physical cash. So this traps people all of the time. The only things that are exempt from this are Hong Kong will be really glad to know are things like jewelry and watches, things that you can wear. So clothing, jewelry and watches, any other asset worth more than £1,000 sterling will be taxed if you physically take it into the UK. The other one that people don't realise, it happens all the time, is if you use your Hong Kong credit card in the UK and then pay the bill in Hong Kong, that is a remittance into the UK because you spent money in the UK to buy products and services there. So that's taxable. If you take out a mortgage in Hong Kong to buy a property in the UK and then you pay the mortgage with your Hong Kong income, that is also a taxable remittance into the UK because the property is in the UK. That's what brings it into the UK tax net. Same thing is for any loans that you have. So your bank will say to you, well, don't bother remitting money into the UK, borrow money from us, the bank, and use that in the UK to fund your lifestyle. Well, firstly, if you put up any security for that loan that's derived from Hong Kong income and gains, the amount of the security you put up is a taxable remittance. Also, though, if you service the loan with your Hong Kong income and gains, that is another remittance. So if you use a loan in the UK, you can end up paying tax twice on doing that. So these are the sort of traps that people fall into. They're peculiar rules to the into the UK as services provided in the UK. So a very common example is you're in the UK with your children, you send your children to a fee-paying school, and then you remit Hong Kong income to the school's account to pay the school fees. The banks say to you, oh, you're from Hong Kong, we've got a clever idea. We've got an account in Hong Kong as well, so don't bother paying the school fees into our UK account. Pay it from your Hong Kong account into our Hong Kong account. So no money has gone into the UK. It's gone from one Hong Kong bank account to another one. But there's a service being provided in the UK, which is the education of your children. Therefore, this is not going to work. The remittance from your Hong Kong bank account to their Hong Kong bank account is actually a remittance into the UK because it's paying for a service in the UK. This is taxable. Another one that people don't realise is any flight that lands in the UK or takes off from the UK to anywhere else in the world, if you pay for that with your Hong Kong income, that is a taxable remittance because that plane has been in UK airspace. So imagine you're flying your partner, your children into the UK from Hong Kong, flying Cathay business class. The total value of all of those flights added together is a taxable remittance into the UK. And that the cost of those flights will be taxed at up to 45% in the UK, even though that isn't a remittance of cash. That's the plane entering UK airspace, it's taxable. So it's not only for anything that you have for your own benefits, so for your own flights or for any other services you have in the UK, it's also for anything what they call a relevant person. So a relevant person is you, it's also your partner, and it's any children under the age of 18. So if it's your children's school fees and you're paying for them, but you're not getting the benefit, your children are, that is still a taxable remittance. Or if you remit money and give it to your partner in the UK, that is taxable as well. Also, if you're living in the UK and you've got grandchildren in the UK, so if it's the grandparents in the UK that are paying for the grandchildren's education, that is also a taxable remittance as well, and full tax is payable. Also, if you've got an offshore company or a company in Hong Kong and you pay money through that because you're connected to the company, that's a relevant person, that is also taxable. And also any trusts that you have any connection with as well, those are also remittances. So you cannot get around using products and services in the UK and paying for them through any kind of entity like a company or a trust. It is all fully taxable. Okay, so what are the types of remittance? Well, the first one is something called clean capital. Now, this is not tax because it's clean capital. I'll explain more about what this is in just a second. Then you've got income, and remember, it's any form of income. It can be salary, it can be rental income, it can be dividends, it can be interest. That is taxed in the UK. And then capital gains. So that's when you sell anything at a profit, that is also going to be taxable. Now, for a lot of people, their bank account in Hong Kong will contain a mixture. So there'll be some income in there from their salary, for some bank interest. There might be capital gains in there because they've sold something and the money's gone into the Hong Kong bank account. So if it's a mixture of one or more of those items, that is taxable because it's what we call a mixed fund. So let me show you what we mean by this. Before you're UK tax residents, everything is clean capital because you're not UK tax residents, okay? So for a non-UK tax resident, clean capital doesn't really matter. But as soon as you do become UK resident, which remember can be before you arrive in the UK, it can go back to the previous April, this is no longer the case. And this is where one of the traps is. So from that point onwards, when your UK residence starts, which will almost certainly be the 6th of April prior to you arriving in the UK, clean capital can only be cash and a particular type of cash as that. I'll show you why. Any other asset you own is then potentially taxable. So anything that's not cash cannot be clean capital by definition. Now, if you've got a mixture, if you've got a bank account that's got a mixture of capital and interest that happens after you become a UK resident, it's called a mixed fund. And the consequences of that I'll show you now. So if you make a remittance to the UK from your Hong Kong bank account, because it's just a single account with money in it, it won't be clear how much of that money began life as capital, how much of it was interest, how much of it was salary, how much of it was rental income. So they have something called the ordering rules, which depends upon how that remittance is going to be taxed. So they're usually disadvantageous because they'll treat income as being remitted first, and income is obviously taxed higher than capital gains. and capital isn't taxed at all. So let's show you an example here. So we've got a lady living in Hong Kong. She's got a savings account at HSBC here with 10 million Hong Kong dollars in it. Now, because she's not UK resident, this is clean capital. That's fine. But then she moves to the UK and her UK tax residency commences on the 6th of April 2020. So she actually moved there in September, but because it goes tax year to tax year, her residency began in the UK before she physically arrived there. Now, clearly it's her first year of residence, so she's going to use the remittance basis because it's free for the first 7 years. Now, on the 30th of April, while she's still living in Hong Kong, the bank adds interest to her account of 200,000 Hong Kong dollars. Even though she's not physically in the UK, because she moved there and spent enough days there, this has an effect on a UK tax. So on the 30th of April, she has no idea that this is going to have an impact later on after she moves to the UK. So that's what's called tainting the account, because it's no longer clean capital because it was added to the account after her tax residency commenced, because it's got a mixture of capital and income, the income being the interest. So it's all still cash, but there's two types of cash in there, but they're mixed up. And once it's mixed, it's not possible to unmix it or to untaint it. So the bank, the bank in Hong Kong has no idea Eleanor's going to move to the UK. She hasn't told them because she's not moving until September. So they're unaware of the consequences of their actions. That they, they've been perfectly innocent in this. So this is what it looks like. There's Eleanor's 10 million of what was clean capital up until the 6th of April 2020. There's the interest that the bank had on the 30th of April. That's now turned that into a mixed fund. So it was 10 million of capital and 200,000 of interest. Now it's mixed up together. It's like making scrambled egg. You can't unscramble it. Okay. So then on the 4th of May, so she's tax resident, she remits money from Hong Kong to the UK. And because her tax residency began on the 6th of April, this enters the UK tax system. So she remits 500,000. How is that treated for the ordering rules? Well, that dictates that any income goes before any capital. So they say that the whole of the 500,000 is not done proportionately. They treat all the interest as going first. So the whole 200,000 interest is gone first, and then 300,000 of capital. So the 200,000 of it is subject to income tax. Now, that's a completely unnecessary tax bill. This could have been very legally and cleanly avoided. Let me show you how. So there's our clean capital. We get the interest, but we don't add it to the clean capital account. We set up a segregated income account for the interest to go into, so it's not mixed up. It's still separated. So now we've still got 10 million of clean capital, and Eleanor can remit any amount up to 10 million into the UK and not pay any tax. In the previous example, she would have been subject to a very high tax bill on that interest going into the UK. So that's just one very simple example of how you can have a tax advantage fully legally, but also how easy it is for the bank to make a mistake and to land you up with a tax bill that you really don't need. Okay, in terms of the amount of the remittance then, so Eleanor's becomes UK resident, but she keeps most of her money outside of the UK. And one of her friends starts up a company and she decides to invest $1 million of her Hong Kong income into the company. So far, so good. Everything's outside of the UK, no UK tax on doing this. Unfortunately, the company doesn't do very well. So the value of her shareholding goes down a lot. So she decides to sell her shareholding. She only receives 20,000 Hong Kong dollars back. She thinks, okay, it's only 20,000 Hong Kong dollars. That isn't much. I can remit that to the UK and pay, tax just on the 20,000. The way the ordering rules work is we need to work out where that $20,000 came from. It's derived from a 1 million Hong Kong dollars of her Hong Kong income and gains. So what she's remitting to the UK is not the 20,000 she got back from selling a share. It's the $1 million she originally invested into it. This is the way that these rules are derived. So not the 20,000. So she's only physically remitting 20,000, but the tax bill is on the original $1 million. So a massively different outcome because she wasn't aware of how this works. Now there's no minimum level here. If that $1 million had shrunk to $1 and she remitted that $1 to the UK, that would still be taxed as $1 million. Shocking, but true. Okay, I'm just going to scoot through some slides because I want to make sure Hannah's got enough time to cover the examples here. This is just the common reporting standard because people say, oh, the UK taxman will never find out about it. Well, they will because we have the common reporting standard, which is where countries report income to each other here. So, sorry, just forgive me scrolling through these. Now, there is a double taxation treatment between Hong Kong and the UK. So what this is designed to stop you paying double tax, and that's why it's called a double taxation agreement. So in Hong Kong, the main ones for individuals are salaries and property tax. In the UK, so it covers those taxes. It does not cover inheritance tax. Okay, this is just taxes that you pay while you're still alive. In general terms, if Hong Kong tax has been paid on Hong Kong income, then it won't be subject to UK tax. But if you're paying property tax in Hong Kong at 15% and your tax rate in the UK is 40%, and you remit that money after Hong Kong tax to the UK, you'll have to pay another 25% tax in the UK. You get the credit for the 15 you've already paid in Hong Kong, but if you're a 40% taxpayer, you have to pay 40% tax. So there'll be another 25 or possibly 30 on top of that. If no tax has been paid in Hong Kong, so if it's interest or dividends, you won't pay tax here, but you remit that to the UK, that will be subject to UK tax because there's not a double no tax treaty, it's a double tax treaty. So again, you just need to be aware of that. Now I'm going to hand back to Howard, who's going to talk about some of the good news, which is the planning that you can do.
Okay, right. So a few examples then. So some of you are probably wondering, you know, is it still worth moving to the UK? And I'll just remind you that yes, the taxes are higher, but very often the social benefits are higher as well, like the education, medicals, and so forth, and pension schemes. So we look at it then and says, well, what's the best way to do it? So let's go through this. So what we're really looking at is once you become that tax resident, you have to distinguish between clean capital, income and gains, and that's the critical aspect for that. Anything that's mixed will be ordering rules applied, and you can pay up to 45% tax on the amounts that's been remitted. And you can't unmix it, which has been clear. Jason said that a few times. It's scrambling an egg. You can't unscramble scrambled eggs. So you want to keep separate bank accounts for your capital, income, and gains, and keep it clearly defined and reporting that way throughout your term in the UK. However, there are some effective planning, which we're going to look at now, but they usually have to be done before you go to the UK. Now, let's have a quick look at it then. So the first one then is, if you have enough cash and it's clean capital before you go and you keep it from being tainted and you keep it clean, then you probably don't have much to worry about when you're in the UK. You could just remit each year, do your calculations each year and work out whether it's best to do a rising or remittance basis. However, if you're holding so much cash, you're losing what's called the opportunity cost, i.e. it's just cash and it's been eroded by inflation, its purchasing power is dwindling. And over the timelines we're looking at, over 10, 15, 20 years, inflation can have a huge impact on your purchasing power. So most people want to invest it at least. So you may need to supplement your clean capital though from by liquidating your assets overseas and to remit it back, and or your income. You could be still earning income in the UK, in Hong Kong. You may be running a business from the UK, a lot of online businesses these days. You may have rental income from property or dividends from portfolios, all those sort of things. You may still want to, or you may need to remit those back to the UK. So if you have all of these things, all these issues, we need to start looking at some of these things to look at. So give you a quick example. We got Anne and Charlotte, two sisters, both investment portfolios. They invested in Tencent in 2016. Clearly, they've done very well on that now. They put 500,000 in there, and they moved to the UK in April 2020, and that shareholding was at that time 1.67 million. After 2 years in the UK, they decided to settle and buy apartments, and they both need money for the deposits. Okay, they're both unfortunately been using remittance basis all the way through, but why it's unfortunate, it's not clean. They've been mixing it up. So, and by the way, at this point in time, 2 years later, the shares have dropped a little bit. There are volatility in these stocks, and at that time it's dropped. So they decide to sell these shares instead. Now let's have a look at a couple of examples. So the calculation broadly for Anne So it's £22,000. So she needs the gain here is the 1.6 million or 160,000. Take away the cost of purchase, which is a gain of £110,000 left, or about 1.2 million Hong Kong dollars, and the tax bill is about 250,000 Hong Kong dollars. Now, Charlotte was a little bit different. She took some advice. Before she moved to the UK, she took some advice that told her to sell the 10-cent shares when it was at 1.67 million, and then she bought them back the very next day. Well, that had a big impact on this calculation because there was no capital gains tax in Hong Kong on the gains. So effectively, whilst she was a non-resident in the UK, she banked her gains, if you like. So all it cost her was 3,000 Hong Kong dollars in stamp duty, and that was it. So her scenario, when we went to the UK, was 160,000 minus 167. She made a loss. So therefore, there's no capital gains. So there is another way though. So we've got remittance, we've got a rising basis, and each year you do the calculation yourself and obviously monitor what you're emitting or not through services and products. But there is another one, which is using insurance, so how that can be done, because there are specific rules and regulations in the UK around how insurance products are actually taxed. So generally speaking, things are held personally in your name, via a bank account, even on a nominee basis, they are subject to taxes. So you've got income tax on dividends, interest and rent, and capital gains on anything that you sell with a gain. So it could be within an existing portfolio. You're not cashing in the portfolio, you're just selling one fund and buying another. That will create a gain. So, however, if you put it inside an envelope or investment linked insurance schemes, PPLI, or what the private banks call it, then it's treated differently. There are tax advantages. So here we are of the UK government's website referencing insurance policies and the taxation thereof. And you can see is what the one where last updated was June 2020, so very, very recent indeed. So the key one we're looking at today is the portfolio bonds. Why are these significant? Because if it's inside an envelope, a life wrapper, then the reality is the gains inside it, or the incomes inside it, are not taxable. Okay, and the taxes are therefore deferred till when the policy becomes to maturity at the end, and then you start paying taxes on how you run your finances at that stage. To give you an idea, that then if you pass away, it comes to an end, or if you do a full surrender, it comes to an end. But otherwise, these are whole of life. They will run for the rest of your lives. Now, all income inside the policies I've just said will actually grow tax-free. But if you had it in your own name, only 55% of it, if you're a high rate taxpayer, would you be able to take. And likewise, the capital gains, there's 80% of it you'd be able to take if it was outside in your personal names. So this is called gross roll-up, when we have assets inside the portfolio rolling up without paying any taxes. Well, what are they? What can they do? Well, on the right-hand side, you can see the type of things that they can hold, but there are multiple currencies. You can put cash in there, mutual funds. We can transfer them into in specie. It's another technical term. I can go through at a later date with you. And they just go on. So the reality is, inside, nothing's taxable. It goes up to the owner. The legal owner is now the insurance company. You're the beneficial owner of the assets inside that. And the insurance company based in the Isle of Man. The Isle of Man is just like Hong Kong. There's no taxes on the gains or income from those investments. So what about your existing portfolio? So if you've got something with a private bank or an online platform, technically, we can actually just transfer those across into a portfolio bond. Then what will happen is you'll have the portfolio bond in your name, and underneath inside it would be the exact same portfolio that you had before within certain rules. So it keeps control of your assets the way you want it, but equally the benefits of the taxes. So what if you need to withdraw some money then? So if you've got to gain, let's reference back again to the government website, and you'll see it here. So zooming in, so here we can take out 5% per annum without incurring a tax bill, 5% of the original premium invested. However, if you don't take it in any one year, you can roll them up. So if you don't take 5% in one year, the next year you can take 10% and not pay any taxes on that amount in the UK. So let's look at it. So if you've got enough money and you put it inside a portfolio bond and you can survive on your income of 5% per annum, you won't pay taxes for the next 20 years on the income you take from that portfolio bond. That's a significant savings. If you take less, 4%, you can go for 25 years or 3 for 33 years because it's related to the original investment. Now, the big thing here, back to the old adage, clean capital is the issue. So clean capital must go into the portfolio bond on outset, which is another reason why these usually need to be done before you go to the UK. All right, I'll skip through those just for time. Now, let's give some examples of how these work. So again, two sisters, different two sisters to the previous ones. They moved to Hong Kong. Sorry, there, I got a scan. They have identical investment portfolios of $50 million each. They're growing at 5% per annum on average from a combination of income and gains, and they need £120,000 a year to live in the UK, and they plan to stay for 5 years initially. So scenario one for these sisters. So Bella, she moves the full 5 years worth of income into cash, into a clean capital account, and the interest is paid into a separate account, so they're not mixing it. The remaining 4.4 million is in her portfolio that she invests, and she just remits £120,000 a year from her clean account. After 5 years, with those assumptions, the portfolio is worth 5.6 million. Now, of course, in the separate account, she's got £36,000 accrued as well from interest. So Claire, she's put her money into a portfolio bond for this analogy. She withdraws 120,000 per annum on liquidating assets as and when she needs to liquidate them. So she hasn't got the opportunity cost of holding too much cash. She is allowed to take 5% per annum without paying the tax. After 5 years, it's worth 5.7, marginally more because it's all invested. So she's got about £100,000 more. We spent £1 million Hong Kong dollars more over that period of time, in that example one. Example two, what if they need to draw down cash? Okay, so after 3 years, they decide to buy apartments in London. They need £500,000 for deposit. So Bella, she's still, after 3 years, got 2 years worth of income and clean capital left in her account, so she considers that. But she's going to need to have income anyway in the next 2 years, so she's going to have to remit money for that. So she's either going to remit it and pay tax, or remit it and not using the existing clean capital. So she decides to remit 260,000 net and not use the 240,000 because they're somewhat similar. So to do that, she needs to remit the full 500,000 and pay tax, but it's from a mixed fund and ordering rules apply. So if you go through that with the assumption of orderings, paying your tax of the income tax initially, then capital gains, and then the capital goes, she's going to need to move 881,000, call it 9 million Hong Kong dollars, to receive broadly 5 million Hong Kong dollars in net money. So she's paid 3.8 million Hong Kong, 4 million Hong Kong dollars in tax to receive that. Claire, well, because she's got the 5% per annum allowances, which is 250,000, but she's only taking 120 of it per annum, she's left 130,000 unused. And remember previously I said you can carry forward those. So at the start of the year 4, she's got 130 times 4, which is 520,000 of unused 5% allowances she can draw down without paying any tax. Or, importantly for a lot of us, completing a UK tax return, which can be quite complex. So let's look at another one. They decide to stay a bit longer than initially planned. So 5 years was the original plan, but now they like it, they're staying. So Bella's used up all of her clean capital now, and she starts to have to remit income from capitals and gains. So now what that means is she needs to move broadly 2 million a year of Hong Kong dollars to receive no, £190,000 to receive 120, which is 700,000 in tax she has to pay each year. Claire, she's still got a portfolio bond running. Remember I said it's a whole of life structure, so it stays with you for the rest of the life unless you surrender it or you pass away. So she's still got those 5%. She can go for 32 years because she's drawing down less than 5% per annum before she needs to start considering paying tax. Now, after 7 years, then remember what happens to the remittance. After 7 years, you start getting a fee of 30,000 a year for the remittance basis to continue. So Bella has to start paying that on top of the tax that she's already paying. Okay, so far now she's paid 525,000 in taxes, 5 million Hong Kong dollars in taxes. That's quite a lot of money. Claire, no change. Scenario keeps going. So she's now broadly 600,000 better off by using the portfolio bond in this example, 6 million Hong Kong dollars. Now, after 12 years, we know you got it. That remittance charge increases to 60,000. So that's now increased. And her portfolio bond is roughly similar. Sorry, her portfolio is roughly similar to what she started out with 12 years earlier because of the amount she's taken to live on and the taxes. So she's paid £1 million or 10 million Hong Kong dollars in taxes now. Claire, no change, still going. In fact, she's now 1.3 million pounds better off, or 13 million Hong Kong dollars better off. Paid no income tax to date. And she doesn't pay those ongoing fees. After 15 years, it changes again. They become deemed domiciled. So now the entire portfolio is brought into the global taxes on the entire portfolio. So she has to pay tax on everything, whether she remits them or not. So far, she's paid 1.4 million in taxes. Claire is also domiciled, no change. Now she's about $20 million better off. So an alternative scenario again is, what if they earlier on both get married, which can happen, I suppose. So HMRC will assume you're now a domicile of choice, which was explained by Jason earlier. So you're no longer waiting to 15 years for Bella before she goes to a rising basis and worldwide and tax on her worldwide income and gains. It kicks in straight away after 6 years, 7 years. And she still has to pay her £70,000 a year in taxes. Claire, there's absolutely no difference. So in summary, just to wrap it up in the background here, what I will say though, is I'm giving you a couple of examples of these type of people, what they have and options. No two people are the same. So you really need to take advice, as your circumstances could be different and we can come up with different strategies. But in summary, it's a recognition that UK taxes is complicated and high compared to Hong Kong. Remittance basis has its advantages, but there are definitely traps. You need to do your annual tax calculation to decide whether you use remittance or arising in that tax year. Okay, and if you get that wrong, you may pay too much tax as well. So it's every year you need to do that. Using insurance is simple, it's highly tax efficient, and it avoids accidents and oversights. We are naturally just human, so you could bring something into the UK on a remittance basis without realizing, and that could mess up your calculations that you've been aiming for. So take advice, start planning early, and do it before you go to the UK is what we always say. You can do it while you're in the UK, called split tax years and so forth, but there's no guarantees and it becomes very complicated. So it is best to do it before you go. So on that note, we're finishing now, and I think we're broadly just over the hour. So unless we've got any direct questions, anybody? Now, what I'd say is this is complex. BMP, we work together with various lawyers, visa professionals for immigration purposes, tax advisors for a lot more complicated tax scenarios. And indeed, even if you're trying to look for schooling or property, we have connections in the UK for that. And if you're looking for mortgages for your property is very complex if you're not been based in the UK for a while. And we have connections for that. We're part of a group that has operations in the UK for further wealth management to look after you, plus mortgages. And on that note, I haven't had any questions, so we'll stop here then, and we'll reach out to all of you afterwards. We'll send copies of this video so you can look at it in your leisure, and have a great day. Thank you very much.